Ladies and gentlemen, today we'll be focusing on the financial projections of IntiMates. Let's begin with the first part, total cash needed. When it comes to revenue drivers, we identify three main sources: in-app advertising, freemium upsell, and commission. Moving on to the three types of cost drivers, COGS accounts for 24.2% of total cost, while SG&A represents 67%. The remaining 8.8% is made up by service R&D. To provide you with a clear picture of the total cash needed, we have divided the estimated expenses into fixed cost and variable cost, which are further detailed in the slides. Taking into account these costs, the total cash needed for IntiMates is projected to be 4,542,880,000 dong.
Hi, I'm V, and now we move on to the second part, comparison to the industry averages or financial performance of similar businesses. What we have here is the income statement of IBC in 2019, but take inflation into consideration, and also the 2024 projected income statement of IntiMates. 2019 was the first year IBC went into operation, so IBC's 2019 data, considering the inflation rate, is chosen to compare with IntiMates' 2024 data to have the equivalent frame of reference. Next is the list of assumptions for the first year income statement, including ones related to the inflation rate, COGS, SG&A, etc. We have the balance sheets of IntiMates in the first year. Assets include cash and fixed assets. We assume that there is no liability, and equity includes retained earnings and initial capital. What's noticeable here is that IntiMate cash will equal net income plus accumulated depreciation. There are also assumptions for the first year balance sheet you can see on the slide. And now, ratio comparison part. We choose 6 ratios. The first 5 ratios are profitability ratios, and the final one is an activity ratio. As we calculate, all IntiMates ratio will be higher than IBC's, which means that IntiMates will be more efficient at generating profit from its invested capital, from the existing equity, and from its assets. IntiMates will also be more successful in producing profit over and above its cost of goods sold, generate higher net income when receiving a percentage of revenues, and generate more revenue from its assets.
Link beside income statement balance sheet that we mentioned, I will present the cash flow statement that our group has projected for IntiMate in 2024. Our estimation for cash flow statement is based on the following assumption, as you can see on the slides. It can be seen from our cash flow statement that the net cash flow will rise from zero to a positive number of approximately 350,000 million in 2024. To make it easier to analyze our financial feasibility, we also conducted specific financial projection for each quarter in our first operating year. First, based on the projected cost structure and operating capacity in the first year, we have estimated the revenue for each quarter in 2024. To estimate and forecast quarterly income statement for IntiMates, our forecast quarterly income statement is based on the following assumptions. First, IntiMate will register no revenue deductions, since our service is only available after full payment. Therefore, the revenue reduction in all quarters of the year will be zero. Second, our quarterly balance sheet is built based on 5 assumptions. First, IntiMate cash in each quarter will be equal to its net income and depreciation. Second, IntiMate purchase all of its fixed assets in quarter 1 and will not purchase more in the following quarters of the year. Third, depreciation in quarter 4 will equal to 2024 depreciation, and depreciation in quarter 1, 2, 3 will equal 0. Fourth, retained earning will counted in quarter 1 only, as at the end of the year. Fifth, initial capital will only presented in quarter 1. And finally, our balance sheet in each quarter is balanced. Here's our balance sheet for each quarter. About our quarterly cash flow statement, My
name is Nguyễn Phương Anh, and now I'd like to take turns to provide insights into our break-even analysis. To calculate the break-even point, you can utilize the following formula. Therefore, the break-even point of our startup is 40 43,858 units of sales. Today I will present to you the financial projections for our company in the years 2025 and 2026. In the first year, our company is expected to turn a profit, albeit requiring 3 quarters to break even. Over the next 2 years, we anticipate strong growth thanks to our presence in the technology sector. Over time, we foresee a decreasing ratio of cost of goods sold to revenue. This reduction is driven by several factors. Fixed cost per unit decreased due to reduced depreciation, assuming accelerated depreciation. Fixed raw material prices from before will result in a decrease in cost per unit. Selling prices will increase to account for inflation, leading to an increase in the price per unit. Consequently, the cost per unit divided by the price per unit decreases, translating to a reduction in cost of goods sold as a percentage of revenue. Our selling expense is projected to remain constant for the next 3 years. Similarly, general and administrative expense is also projected to remain constant over the next 3 years, indicating a commitment to cost efficiency and control. Over the next 3 years, we predict that the effective tax rate will remain constant at 20%. The forecasted increase in net income over the next 2 years is remarkable, indicating significant growth in profitability. Let's shift our focus to the company's cash position in 2025 and 2026. During these years, we expect a notable increase in our cash balance. This increase will be greater than the sum of our net profit plus depreciation. Next, let's discuss our fixed tangible assets. Over the next 3 years, there will be no new capital expenditures, indicating stability in our asset base. This means that our fixed assets will remain unchanged for the foreseeable future. Our equity position for 2025 and 2026 is equally noteworthy. The initial capital will remain unchanged, and the increase in net income will lead to an increase in retained earnings. This increase in retained earnings will subsequently result in an increase in owner's equity capital. Let's delve into the cash flow aspects of our financial projections for 2025 and 2026. In our case, there will be no other cash flows generated from operating activities. Therefore, we recognize a cash inflow at the end of the period. Considering the absence of new capital expenditures, we anticipate no cash inflows or outflows in the cash flow from investments category. Likewise, as we don't foresee the need for new contributed capital, we project no cash inflows or outflows in the cash flow from financing activities during these years. Our cash flow projections are notably positive for the next 2 years. Then, here is the list of our assumptions for income statement, balance sheet, cash flow statement, calculated on an annual and quarterly basis, respectively. That's the end of our presentation. Thank you very much for your time and attention.